Owner financing allows a home buyer to pay the seller directly instead of getting a traditional mortgage from a bank. Essentially, the seller acts as the bank, collecting monthly payments from the buyer over an agreed period of time. Because no traditional bank is involved, the process can often move much faster than a standard home purchase. The arrangement is governed by a promissory note, which details the interest rate, payment schedule, and what happens if the buyer defaults. Unlike a rigid bank loan, owner financing offers flexibility for buyers who might not fit traditional lending criteria. This chart shows a common structure where smaller monthly payments lead to a larger final balloon payment to settle the debt. Because these deals are private, legal oversight is essential to ensure the contract is enforceable and fair for both parties. Owner financing is a unique tool, but it carries risks. Consult a professional before signing any agreement. Thanks for watching.